Hey, it's Brendan Spear with Caprika Realty. Just wanted to talk to you about knowing who your seller is. Now, I believe it's important to know your seller because different types of sellers will have different parameters. Some sellers are going to be more emotional, some it's all business, and some don't have a lot of decisioning power. So it's important to know what you're trying to get into and what you should expect during the process if you know who you're dealing with. So our first type is our happy homeowner. Now, our happy homeowner isn't necessarily happy. It just might, what I mean by that is that they can afford to sell their home. So when we're looking online, a lot of times you'll see that as standard sale. So your standard sale is your more traditional type of seller. Now again, they may be retiring, moving to Florida. They may, they may be getting a divorce. They're just buying a bigger home, downsizing. Doesn't really matter. What matters is that they can afford to sell their home, and that's what our traditional seller would look like, okay? Now, the downside with happy homeowners is that there could be some psychology involved. Maybe they were married there, maybe they had their first kid there, maybe they grew up there. There's all kinds of different things that could have gone on in that house. So there could be a psychological aspect. Maybe they did a lot of the improvements to the house and you do a home inspection and you're not happy with those improvements. They may be insulted by you wanting them to fix some of those things. So that's our happy homeowner. Now the plus with the happy homeowner is typically they want to sell, you want to buy. So let's try to make it work. So that's, we do love happy homeowners. They're usually the most willing to try to get the job done and to go through the process. But again, just know that there could be some psychology involved. Our second type is going to be our foreclosures. Now, foreclosures are a little bit more tricky than your happy homeowners in terms of the process. I like to say that banks are not emotional, but I also would say that they're not logical. They kind of do things their own way. It's their way or the highway type situation. They're going to do things that are going to be a little bit unfair from their bank addendums, take away some of your rights as a buyer. But on the flip side, they usually offer it at a pretty aggressive price. So foreclosures can be great, but you have to know what you're getting into. Many times I do recommend getting a home warranty, also making sure you get a good home inspection. Another bit about foreclosures is just because it's a foreclosure doesn't mean that it's a good deal. I've seen some foreclosures that are priced way, way high. So you still got to look at the comps, you still got to do all the normal stuff, but just know that banks don't make money by holding on to these properties. So again, they usually just try to get rid of them. You just have to look at it from an objective point of view to find out, is the condition worth it? And that's another thing that can be a little bit of a catch with foreclosures, is that, a lot of times there's deferred maintenance. Just because if the homeowner couldn't afford to keep the home, did they do the normal home maintenance? Did they get the, your heating and cooling unit serviced? Did they clean the gutters? Probably not. But on the flip side, maybe they took perfect care of the house and it was immaculate, but they just fell in hard times and they had to turn their keys into the bank. Well, if they did that, then the rub is, how long did the bank take to put the house back in the market? 3 months, 6 months, a year? 3 years? Who knows? It's all over the place. So you want to look for mold, for water damage, things that just, were deferred maintenance. Now, all that being said, I've had some clients buy some great foreclosures over the years, so I'm not against it. I just want you to go with open eyes and know what you're getting into. Now, our third type of seller is our short sale. So to take a quick little break from the types, I just want to give you a little analogy. Basically, us and your lender, we're your pilot and co-pilot, and we're on a first-class airline trying to get to your real estate goals. Now, I know that's cheesy, but you can imagine when we're talking about going from a standard sale to a foreclosure, that flight's usually a little bit more turbulent, just because there's less things in our control. When you go from a foreclosure to a short sale, there's even less things that are in our control. So the point is, with a short sale, they're an emotional roller coaster. Basically, the whole idea with a short sale is this. The seller, they owe more than the place is worth. Now, let's say, here's an example. Let's say they owe $400,000 on the property, but let's say the value really is at $300 now. So the problem is, you might be willing to give them $300, but then they have to go to the bank and say, hey bank, do you mind that extra $100,000? Can we just not worry about that 100 grand? Let's just forget about that. And that might happen, that might go through. The problem is that's not a quick phone call. That's not like going down to your old savings and loans institution and talking to Bob, the office manager that you've known for 5 years. These things are all bought up by big banks and backed in Wall Street by mortgage-backed securities and a whole bunch of stuff that we don't need to get into for today's conversation. But the point is, it's not a simple, hey, is this okay? The process is you'd write the offer, the seller has to, they would have to accept it, of course, and the seller has to get a whole bunch of information into the bank. The bank then looks over all their financial information. Then they're going to want to know what is the place worth. So they're going to send out another agent or appraiser to go do a broker price opinion to get an evaluation of the property. They're going to look at the valuation. They're going to look at what the people owe. They're going to look at all of their financing. They're going to look at the contract terms. And then they're going to look at the guidelines that they have for that particular property, whoever owns it. And then they're going to come up with something. Now, they could ask for more money. They could say just no. They might say yes. It's all over the map. What I tell people, here's a good example of what I tell a seller. If I'm working with a seller to do a short sale, I say, look, this is going to take a year-long process, and it usually takes 2 or 3 contracts before it actually settles. So if you're the buyer, the thing is, you might go in, it might be in the beginning of the process, you offer an amount that you think is reasonable, it goes 3-4 months, and then the bank comes back and says, no, I want more money. You might not be willing to pay more money, so then the house goes back on the market at that newer price, and then the second buyer comes in, maybe they're willing to offer that amount of money, and maybe it goes to settlement, maybe it doesn't. So there's no direct outlay of cash that's a direct risk for you if you were to write on a short sale. It's more of the emotional roller coaster that you don't know what's going to be going on, the time that's involved, and meanwhile houses are coming in and off the market and interest rates might be moving up and down. So it just becomes very stressful. Another thing, just a little tidbit, is what if they have more than one loan, the seller that is? If they did an 80-20 loan that was popular in the early 2000s, you have to get the permission of every lien holder to go through with the short sale. If it has a condo or HOA, again, they may have a lien against it. You have to get the okay from them. So it can get very complex very quickly and just a lot of hands in the cookie jar. And basically, we just don't have a lot of control, particularly about the timeline. So if you're in a hurry, I recommend that you avoid short sales. What I tell most people is, unless you're an investor, skip short sales at first. Look at foreclosures, look at happy homeowners, try to find a deal that's going to make sense to you. If you can't find anything near price point for the area that you want and you have nothing to lose, then go ahead and write on a short sale. But if you want to try to save yourself some heartache, you probably want to avoid short sales for now. So those are our 3 major types. We also have new construction and also estate sales, which I'll talk about in another video. I group them into your standard sale or your happy homeowner. There are some nuances about them, but the key is that they can afford to sell their house. So again, we have our happy homeowners, our foreclosures, and our short sales. So those are our 3 types of sellers. I hope that made sense. If you have any questions on any of it, please feel free to give me a call or shoot me a text or an email. I'll be happy to go over it with you. Thanks for watching.